I'm Helen Morgan and I'm Tax Manager at ACM. You may have heard in the recent budget that from the 6th of April 2023 there have been a number of changes to pensions. I will explain these changes in this video and end with a note on filling gaps on your national insurance record. An individual can contribute to any number of pension plans. Personal contributions made by an individual are unlimited, although how much you can pay into your pension depends on individual circumstances. However, there is a limit on the amount of gross contributions an individual can pay each tax year and fully benefit from tax relief. Tax relief on personal contributions is restricted to the hire of £3,600 per year, or 100% of relevant UK earnings, such as wages, trading income or income from a furnished holiday letting, but not investment income such as dividends and rental income. Tax relief is only given in the tax year that the contribution is paid. Total pension contributions are also subject to an annual allowance. This is the total amount of contributions that can be paid into all pensions for an individual before a tax charge applies. This allowance applies to all contributions, so individual and any employer contributions as well. The annual allowance is currently £40,000, increasing to £60,000 from the 6th of April 2023. Currently, individuals can carry forward any unused annual allowance from the previous 3 tax years, as long as they were a member of a registered pension scheme in that year. If contributions exceed the available annual allowance, there is an annual allowance charge on the excess at the individual's marginal rate of income tax. The annual allowance is adjusted for high earners and for individuals who have adjusted income above £240,000 or £260,000 from the 6th of April 2023. The standard annual allowance reduces or tapers down by £1 for every £2 above the £260,000 threshold. The minimum tapered allowance is set at £4,000, and this is the minimum allowance, and that increases to £10,000 from the 6th of April 2023. It's also worth mentioning here that after you have started to draw your pension pot, the standard allowance is replaced by the money purchase annual allowance, which is the same limits as the minimum tapered allowance. So that's £4,000 for 2022-23, increasing to £10,000 from the 6th of April 2023. The tax treatment of defined benefit pension schemes is similar, but instead of comparing the contributions made, the annual benefit is compared to the annual allowance. Defined benefit pension schemes are usually workplace pensions, and they are sometimes called final salary schemes. Essentially, the amount that you get depends on the scheme rules, not how much you have paid in or on investment returns. Currently, a tax charge will also apply if your pension pot exceeds the lifetime allowance of £1,073,100. From the 6th of April 2023, this lifetime allowance charge has been removed and expected to be abolished from the 6th of April 2024. The maximum pension commencement lump sum, which is tax-free cash, for those without lifetime allowance protections will remain at 25% of the current lifetime allowance of £268,275 and frozen at that point. The lifetime allowance has reduced a number of times over the years, and individuals could apply to protect their lifetime allowance at a higher amount. HMRC have confirmed that anyone with fixed protection or enhanced protection in place at the 15th of March 2023 will be able to accrue new benefits, join new arrangements or transfer from the 6th of April 2023 without losing their existing higher tax-free cash protection. However, we would advise careful consideration before making any changes, just to make sure that it doesn't have any unexpected effects. It's also worth bearing in mind that the lifetime allowance could be reintroduced again in the future. And again, this is only from a tax perspective, and you should always seek independent financial advice. And finally, a note on in national insurance. The rules around filling in gaps in your national insurance record are changing. After the 31st of July 2023, you will only be able to make voluntary contributions going back 6 years. If you do have gaps in your record, filling them in now could boost your retirement income. So you have until the 31st of July 2023 to pay voluntary contributions to make up for gaps in your national insurance record going back to April 2006 to date. You can use the government state pension forecast tool to check when you'll reach state pension age and your national insurance record by searching for state pension age or via your personal tax account or by phoning HMRC. To receive the full state pension, you'll normally need 35 years on your national insurance record. If you have less than that, then you'll receive a lower amount of state pension. If you're missing years, you can make additional voluntary national insurance contributions to fill in the gaps. And if you do have gaps, also check if you're eligible to claim credits for those years. For example, credits are available if you were a carer for a family member or caring for a sick or disabled person. In some cases, the credits will be applied automatically, but others you have to claim for. You can also see more information on the government's National Insurance Credits page. And then if you do have gaps in your record, you can then weigh up whether it's worthwhile paying to fill in the gaps compared to the potential increase in state pension in the future. This will vary depending on your individual circumstances and will depend on many factors, such as how long until you reach state pension age and how long you expect to work for example. I hope you found this useful. If you do have any questions or would like any further information, please contact either myself or one of the tax team here at ACM.